Good morning, everybody. This is Patrick MontesDeOca with the Equity Management Academy live trading room, live streaming from TicketTacker. We're looking at the board here, the Tradestation Platform. This is the automated platform that we have pretty much coded the VCPMI in all the markets. We have about 80 algorithms that we're running in real time. And for the purposes of this presentation, this live show that is being presented live streaming from TicketTacker, what I'm doing here is I'm actually showing you how I am executing the VCPMI, how basically one self-directed trader should use this tool as a guiding tool, as a GPS for your trading. The gold market is trading last 1727, down about 380. Silver is at 2604.50, up about 4 cents. Copper 410, up 3.5 cents. The E-mini S&P is down about 1450 at 39.38. And as we take a look at the derivatives, it's a little bit choppy here on the basis that we have the expectation of interest rates, a big decision today on interest rates. The 10-year bond is rising in yield, which I think is beginning to put some short-term pressure in the market. We're at 166.90, and we're pretty much making a new high on yield. And so this is putting in a little bit of pressure in the stock market, putting a little bit of pressure here in the metals markets, and in general across the board. The silver market is trading last at 25.99. It's only down about a cent and a half. And gold is down about $7, $7.10. The market is going to be subject to, obviously, any decision that is going to be coming out of the Federal Reserve today with regards to interest rate policy. So it's going to be a pretty choppy day. And what we want to see is simply what the markets, are, how they are interpreting the possibility of this decision by the Fed. And it's anybody's guess what they're going to do. My estimation is that based upon the economic situation that we're dealing with right now, and based on some of the past comments that the Fed has made, they probably are not going to do anything. And they probably are going to leave interest rates as they are, and take a chance that inflation, is not going to accelerate and put more pressure on the 10-year note to rise in yield in anticipation of an acceleration of inflation, which is why interest rates are running up. The conflicting picture is that at the same time that the interest rates are anticipating some kind of an inflation impact in all the stimulus that's being distributed in the marketplace. It's contradictory to the fact that inflation is very bullish for precious metals. And I believe that the perception that most people have that the metals should decline on rising interest rates, I believe is something that one has to really take a look at and see really what are the elements in the system, the economic system that we're dealing with that are different than the previous times. And I refer back to the 70s to begin with. In the 70s, 71, Nixon lifted the gold standard. It's the first time that obviously the dollar went into free float as the US dollar reserve. It became the petrodollar, and that was the beginning basically of inflation in the United States. We saw inflation from the 70s, 70, particularly up to 1981. Interest rates exploded to 15%. At the same time, the price of gold went up from roughly, I believe it was about $135 an ounce to $850 an ounce simultaneously, while interest rates exploded. That's because we were dealing with inflation, hyperinflation, in fact, in some cases. To get interest rates up to 15%, you're talking about hyperinflation. So, can you put that same scenario just to paint the picture here for you guys that interest rates are going to go up to 15%? Is that a reality? Is that possibly something even to consider? I think not. The difference is that obviously rates are near zero on the face of this historic debt that is scratching the ceiling of 30 trillion, if not there yet already. And so it's very difficult as a trader now. I'm not an economist. I'm not a PhD in economics. I'm simply a trader just like you that is trying to make a buck in these markets and making sense of it. And so I think where we are right now is a historic place in history in that we've never been here before with interest rates, near zero, with incredible record debt level, and the debt acceleration, the tail end of this debt is expanding exponentially. It's exploding exponentially if you take a look at just the balance sheets of the Feds. And the argument that I get is that savings are high and people are getting free money from the government, and everybody is the system is pretty well supplied with stimulus, so to speak, which is simply, I believe, on the surface, short term, it's something that needs to be done. The problem is that long term, it's having severe potential implications, inflationary implications. And this is what the 10-year note is beginning to anticipate. The more stimulus that they print, and we're talking, I think altogether maybe 17 trillion if you add all the different stimulus packages that were implemented going back to September of 2019, with the repo market. It's a staggering amount of money that has gone into the system. So the system is flooded with liquidity, which is why it's not collapsing. But being around for a little while, experiencing the 70s, um, there is a reality that we're going to have to come to terms with, and that is, how are we going to pay for all of this stimulus? Who's going to pay for it? Not, I'm sure not the government. I'm sure not the rich, the elite. Although there is a certain policies, economic policies, monetary policies that are moving towards taxation, high taxation, but it's going to affect everybody. So prepare for higher taxes. Prepare for a shortage of supplies. We're getting a shortage of goods across the board. We're getting a shortage of supplies in microchips. We're getting a shortage of supply in plastics. We have a shortage in physical gold, physical silver. If you noticed, things are beginning to get pretty tight with regards to supply. And that's because we're beginning to see the real damage in the supply chain as a consequence of this pandemic that is still prevailing in certain areas. So how do you make sense of all this? And how do I personally want to how do I monetize? How do I capitalize on this? Well, putting aside all these fundamentals, which is to me noise, chatter, the reality is very simple, that the more money that is printed, the less intrinsic value that the US dollar is going to have, the less purchasing power it's going to have, and it's going to begin to shake the boat of US bond investors, foreign and domestic, because the risk right now in the bond market has never been greater if we see a snap in interest rates. And if interest rates continue to go up, it's jeopardizing the whole enchilada, so to speak, that has been prepared for in this new administration. So what I believe needs to happen here in order to contain, control, maybe, or even manipulate the rise in interest rates is that they will begin to talk about yield control. Because they cannot, and I'm talking on a global basis, the world cannot allow for interest rates to get out of hand. It will blow the whole bubble completely. And so there are very few choices. I think that the market is given somebody that wants to, that is aware of what's going on and wants to protect, you might say, the integrity of your net worth. You can certainly take a gamble in Bitcoin, in as some people are. You can buy virtual art at for $62 million, and you get a series of codes. Or you can take a look at the old-fashioned way that money is made, is essentially by producing gold and silver, by producing natural assets are precious metals that are God's given, you might say, way to get out of this mess that our leaders have gotten us into with regards to the monetary system, with regards to what money is. Most people don't realize around the world that we are dealing with fiat currencies around the world, and they're imploding as we speak. The Eurozone committed to buy everything in sight, bonds, ETFs, junk bonds. They are coming in with full uh, full blast, you might say, as far as uh, what kind of tricks they have up their sleeve in order to maintain this fiasco, in order to maintain this bubble of debt that inevitably is going to come to an end. And again, when you think about the different possibilities, and this has been done obviously in the past. I mean, if you go back to Mexico in the 80s, 81s, as a consequence of course, interest rates and all this stuff, they defaulted on the loan. They defaulted on the U.S. loans, and the way they did it is basically by allowing the peso to explode. They went into hyperinflation. And the peso in 1981 went from $16, 16 pesos to the dollar, to 46.50 literally overnight, and it went into the thousands. And if you look back, they've had to, devalue its currency here several times through that process. So when we take a look at this policy of devaluation, which has been pretty much the way that emerging countries, third world countries, have gotten away with. Argentina, Brazil, when their economy runs rampant and inflationary, they can't pay their debt. So coming back here to what we're looking at, there is a very high chance that we could get yield curve control, YCC. You want to listen to the language the Fed uses, because if they do use that language, it will be an explosive scenario for precious metals, particularly for the silver market. What we're talking about here is coming back to the basics of what money really is. And what you need to do, what I need to do, what we need to do as a society is take the value of all of that fiat currency, take that fiat currency, convert it to real money by acquiring silver, by buying silver and gold, which are primarily the driving forces, you might say, of the economic system. Not only monetarily, but in industry, medicine, the application of this two precious metals are incredible. Which is why I am focused, and I trade primarily the metals. I do trade Bitcoin short term. It's a great trading instrument, and we've done quite well with it. But I don't think we have seen yet the giant awakening in the precious metals markets. And when it goes, there are going to be very few people in it, but we will have a lot of people chasing it because they'll come to the realization that real money is silver. It's always been through thousands of years. What we see here in gold is the market coming into let me get my platform going here, into a level of support. And I want to use my Thinkorswim platform here for showing you the charts and teaching how I apply this. The silver market obviously is leading the way today. The aggregates, the derivatives it's a little bit quiet all over across the board, you might say. The only action that we have here this morning is in silver, gold, and copper. We came down to 1722.80 on the gold market that you see here, which is the buy one level, and reverted from that level, and pretty much reverting into the average price that we have today, which is 1731, 1732. We're making that as we speak, and we are beginning to see volatility in the market, ladies and gentlemen. Fast market in metals. Prepare for fast market in metals. $26.11.12 on silver. Fast market on silver. Silver is trading above the average of 26.11. It's activated a bullish trend momentum. By trading above the average, it's negated the previous bearish momentum, and now we're looking at the market breaking out above into a bullish trend momentum that activates the targets of 26.31 to 26.61 for the silver. Gold is breaking through the average price of 1731, 1732. Going to be pretty volatile here today with the FOMC meeting. So carry your long position, hold your long position. For my traders in my Discord room, hold your long derivative positions. A lot of mixed markets here this morning. Obviously, the Fed meeting is having an impact and everybody's recalibrating. So a lot of things are not making sense when you have gold up as well as some of the bearish instruments. So things are a little bit choppy here today. So we just want to observe the volatility of the market where it takes us. Interest rates are beginning to have an impact on technology as well across the board. So it does begin to uh, affect the different sectors in the economy, the different sectors in the stock market. The Dow, E-mini S&P is at 3936, down 1675. Now, what I want to point out here is that, this is what's driving the market fundamentally here, is higher interest rates. Excuse me. Now, sorry. If we take a look at the E-mini chart, I want to point out to you that the price has come down to the area that we call accumulation of supply. So regardless of the chatter, what we want to see here is how the market reacts into this level that is indicating that this is a very strong area of accumulation of supply where you can expect buyers to come into the market. And so we don't want to sell in here. We want to wait and get confirmation of the market trading above the buy one level. And the E-mini is it's at 39.43 is the buy one level. We're trading between the buy two and the buy one level. The buy two level is 39.29, 39.43. So it's into this area of accumulation of support, and it's indicating that you want to be looking at the long side. You want to be looking at confirmation, the market closing about 39.43 in order to get long. We're getting bullish indications here in the metals, interpreting that whatever is going to come in from the Feds is going to be bullish. And maybe even leaked. Somebody might have leaked something, and there you go. The market is up. And silver is picking up a lot more volatility. So, you just don't know what fundamentally the markets are going to do. So I adhere to the numbers. I adhere to the probability factors that are produced by the VCPMI. And it's a combination of different factors. Again, we use pivot points, we use moving averages, we use pretty much wave counts, vortex mathematics, Fibonacci sequences, Gann formulas. So we use a combination of standard indicators, but one of the things that is different in what we do is that the algorithm ignites these indicators into producing a probability model that gives us percentages. Like right now, the market trading above the average, it's a 50-50 standard deviation that has activated a bullish price momentum. The target is 2630 in silver. I don't need to, guess or wonder where the market's going. It's telling me right here. So there are rules that the VCPMI teaches you that if you follow and if you have the discipline, it will produce the results that you're looking for. if you stay out of the way, if you take your emotion out of the decision-making process, and you just allow for the code to activate the signals as I'm interpreting it to you right now. It's very transparent. There's no ambiguity to it. It's a mathematical model that it gave you a buy signal in gold here at 1722. Now it met the target of 732. If depending upon your profile, multiples that you use, you can use these levels to take profits, to book profits, especially if you short-term trading. Let's watch the market trading around the average here. Market is trading above the average here. It's activating a bullish trend momentum. When it does that, it automatically activates the targets above, which are the levels above. Let's take a look at the Thinkorswim platform here and see what it tells us here. What you see here is a perfect completion and test of this code, 1723. You can see the market came down, completed the pattern, and reverted right back up to close above it on this green bar. This confirmed what I just said to you a few minutes ago, that when the price comes down into this level of buy one, you're looking at a 90% probability, if the market does this, that it will come back up to the mean. And if it trades above the mean, like it is now, then it activates the targets above. On the daily, it's 1739, 1748, and right above 1748, we have the weekly 1751 target. So not only have we activated the daily by trigger, but we are in a bullish pattern weekly because it's trading above the average of 1712. And now we are entering the daily bullish price momentum in addition. So I expect that we should see some kind of an acceleration just based on the momentum of the market. So continue to hold your longs, and obviously, if you are trading futures here, you want to be nimble here enough that inflexible enough that when this market is going to be pretty fast and furious. So monitor your risk accordingly, and what I believe is just prepare for volatility like we're getting right now. I'm going to split my screen here so I can take a look at the gold and silver simultaneously as we prepare for the Fed decision. Both markets are trading around the average price, as you can see. So it's a wait and hold here for today. Activating a bullish bias here. So this trade down here in gold, 23 activated a buy, 32 completed. We're entering a bullish uptrend. And this is how you look at this simplistic structure, which is a Fibonacci perfect sequence of 5 different levels, daily, weekly, or monthly. It uses only 5 perfect Fibonacci levels, sequences. And within that sequences, you get the wave counts, the Gantt formulas, Fibonacci retracements, and it's pretty much a compact little trading tool that gives you incredible intelligence. And this is the intelligence that I am coaching and teaching my traders, my subscribers in my trading room. Is how do you apply this systematically? And it's a process that to some people takes a little bit of time, and to some it's simplistic, too simplistic, obviously. And I think as a trader, learning how complex this is, the more simple things become, the more effective it's for me. Bring it down to simple, stupid way that you can monetize is the bottom line. That everybody's goal and objective here is to how do I make money in the markets with all this different technologies and so on. And that's the bottom line. That's the goal. And so for me, I have found that this tool gives me a very specific look at the markets, the time frames, and pretty much tells me how I could manage the risk when I trade those markets, which is really what it's about. It's about managing risk. This is a good example here of what I continuously say is that when you're trading around the average price, it gets very choppy. And as a trader, you want to wait for the highest probability trades, and that is either the market going up to the sell one level, activating, completing that target and activating a short trigger as it did here, and automatically the level below becomes your target, which is the mean. You don't trade the average price. You wait until the price comes down to the extreme below or to the extreme above. In the meantime, if you do trade the average, you're going to get chopped up. So, here's another example. Market came down below the average. It activated a bearish price trend momentum, and the target automatically was the target below 1723 when this signal came in, and boom, completed, reverted back, activated a buy signal. And this is a pretty fast action, so you got to be watching this. If you're day trading, obviously you got to be watching it. And the target was completed 1732 initially, and that's where we are as of now. We're building, we're accumulating supply here, as you can see, and the buy signal here would be a close above 39.43 on the mini. It's very quiet here, as expected here for today. Things toned down a little bit here, but I believe it's going to get a lot more volatile here as we move into the hour of announcement. Silver, both are hanging in around the average price. What you'll see is a lot of trading begins to exchange in the average price. Pretty quiet across the board, basically. Regardless of any opinion today, I think today's markets are definitely influenced by the decision of the Feds, and that goes for pretty much across the board. Very, very quiet here. Quiet. The silver market is holding above 26.08, so that's a good sign. 26 handle is very strong, up about 8 cents. Rates are having a little bit of an impact here on the immediate, on the technology stocks, tech stocks, the Nasdaq. The metals are showing underlying strength here, so there seems to be some buying on any of this correction. <clears throat> 1731.90, trading above the average. We're going to continue to hold our long position here, continue to maintain and use any correction that presents itself to add to your long-term core position. $17.32 trading above the average. $26.12 for silver. That's pretty good buying coming in here. And I think as we move towards the later part of the day, it looks like we definitely are getting bullish indications. $26.31 is the target for silver for the day. That's the sell one level. The sell two level is $26.62. Gold is $17.39 to $17.47 are the targets for the day. I think the target that we're looking for on gold is to move into that 1874 area, which is the monthly average that we're looking at. $18.74 is the monthly average that we are tracking for this month, and I think that's the target that I'm aiming on this move here. Before I think the 1874 is going to be definitely confirmation, if we close above it, that the bottom has been completed, and we're in the process of making this bottom here. As you see, the market came down to 1673 on the 8th, and we've been reverting since, and it has reactivated the buy trigger from the buy one level weekly of 1687. So we're activating, as you can see, weekly signals, daily signals, and if we can get through this resistance level of 1777, we're going to be activating the monthly target of 1781, and the 1874 target will be activated at that point. So continue to hold your long positions, my friends. Have a great trading day. Good luck today. I'll talk to you soon.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.
Steve Collegian here with John Najarian, folks. We're at Master Control here at Ticker Talker. And Steven, this is an amazing platform you've built where basically